Hi, this is Angela Giroux, publisher of the Bauman Letter, and we are back with Your Money Matters. I'm with Ted Bauman and Clint. Welcome, gentlemen.
Hello, how are you doing?
We're good. So today, big news. We're expecting an announcement from President Trump. It hasn't happened yet. We're recording this on a Friday regarding China. We don't know exactly what he's going to say, but if I had to guess, it's not going to be good news for our trade deal. It's sort of just hanging by a thread. So today we're going to talk about what that means for investors, what that means for Chinese stocks, and how that is going to affect all of us in the long run. Now, I saw a stat yesterday. It was released by the Federal Reserve of New York that said that so far, American companies, their market caps have been slashed $1.7 trillion so far because of the trade war. Now, Ted, I can't imagine these companies are very pleased about that.
Well, no, and I think that really is the key issue here. It's the interests of American business versus the interests of the United States, if we can say that we have a single interest versus the interest of White House. That's really what this is all about. And I think the important thing to remember is that the United States business community, certain sectors of it, the most powerful sectors of it, have been the drivers of the economic relationship with China, going right back to the 1990s when China was admitted to the World Trade Organization under the Clinton administration. Larry Summers and others pushed very, very hard for that, and they did it for a reason. Those reasons still exist. So really the big question comes down to political. But before we talk about that, let's talk about the nature of the relationship. And I know, Clint, you've put together some charts that tell us what kind of an economic and financial relationship we have with China. So tell us how deep it goes.
Yeah, so just to illustrate that relationship, there's a couple different avenues, a couple different ways you can look at it. One is obviously just to look at the amount of investment business are making in each country, what U.S. businesses are investing in China and what Chinese businesses are doing in the U.S. Things like taking a ownership interest in a company, building a new facility, expanding a facility, and so on. And that's measured as foreign direct investment, and that's a number that's been growing, ever since you talked about the WHO and what's going on there. And that number peaked out in 2016, right around 60 billion or so, but it's really fallen off the last couple of years. As the trade war kicked in, that number started to dry up, but it really goes beyond just the business investment. When you look at the trade relationship and the linkages between the U.S. and China, that expands to financial assets here as well. So, and when we look at foreign ownership of U.S. Treasury securities, overall, foreign entities own about 30% of U.S. Treasuries. And right up there at the top of the list is China. China is the second largest foreign owner. They have historically, or at least over the last couple of years, run neck and neck with Japan. But China owns about $1.1 trillion worth of Treasury securities that we'll show you in a chart right here. And that number has grown steadily over the years. It's been moving sideways for the last couple of years now. But it goes the other way as well. Foreign ownership of Chinese assets has expanded as well. And that's another chart we'll show here. This looks at the foreign ownership of Chinese-based equities and bonds and how that's grown over the years. And that currently now stands at right around $600 billion or so.
Right. So basically, there has been a two-way flow of money from China to the U.S. and from U.S. to China. And a lot of it has to do with two major flows. One is the purchase of Treasury securities, U.S. government debt by China. It's second only to Japan, as you've showed. The other is just the investment that United States companies have put into China. Now, remember, I said earlier that the Chinese relationship has been driven by U.S. business interests. And if you look across the board, it's everybody. It's everybody from the tech companies right down to the nuts and bolts manufacturing companies like Ford, et cetera. All of them have opened up Chinese operations because it's a huge and growing market. And in many cases, those foreign income, the income that they get is every bit as important as the income that they get from the United States. So people forget, we talk about U.S. companies, but from the perspective of their profits, they are U.S. and Chinese companies. So let me show you a chart that shows the increase in direct investment in China from 2000 to 2018, as you can see, it's just a steady march upwards. So this is a lot of money that US businesses are spending, investing in China. They're building factories, they're opening shops, they're hiring workers, they are developing technology. The next chart I want to show you sort of shows the relationship between the different types of investments. And one of the biggest ones has been direct investment in Chinese companies themselves. For a long time, the main one was in strategic industries like automotive, heavy equipment, etc. But we can see, starting about mid-last decade, that financial investments get big, banks looking to invest. You can see that US investments in electronics industry, the industry that President Trump is so upset about, also very, very high from the United States. And finally, of course, one other thing to remember is that the Chinese are very, very interested in acquiring knowledge from the US in the form of studying here. So really, that's, I think, one of the key considerations is that there's been an interpenetration of the two economies at the business level, at the financial level, and even at the human capital level. And we, in some senses, we can't talk about two different economies. From the perspective of a big American business, it's one big economy that they're trying to maximize their profits from. Now, let's talk a bit about the financial sector. Clint, you've got some charts to show us about what's been happening on that front. That could be the key factor here, isn't it?
Absolutely. I mean, when you look at the major Wall Street investment banks, firms like Goldman Sachs and Morgan Stanley, they also have wealth management arms, and they would love to be able to tap into the potential of China's wealth management industry. And I'll show you a chart here. That's because China's wealth management industry, the assets under management, just over the next couple of years is projected to reach about $30 trillion. $30 trillion with a T. But that's just AUM. Wealth management extends beyond that. That also includes things like, I will show you here, life insurance premiums, capital raising through the securities industry, commercial banking activities. All of these, just over the next 10 years or so, are set to explode and be huge profit drivers for the firms that can tap into China's markets.
Well, you know, this really comes down to the core of the issue. And here I want to introduce the question of what it means for investors, people watching this video. And I think, you know, the truth is that the Chinese have been very kind of two-faced, or maybe two-stream is the way to put it, in their negotiations with the US. When it comes to physical trade, they've pushed back very hard against the United States. They've tried to maintain their advantages as they see them. But when it comes to financial relationships, the Chinese have bent over backwards. I mean, they fast-tracked, they voluntarily sped up a change in their laws that allows US banks to come into China not as junior partners to Chinese equities or Chinese banks, but as complete owners, as the dominant owners. So they can now operate their own branches 100%, if they like, owned by themselves without Chinese partners. That's a huge change. And I think that ultimately, to me, is the biggest single factor here. Now, why is this happening? One, the Chinese banking sector has been relatively undisciplined because it has always relied on the state. It takes the state and the state's financial capacity for granted as a backstop. So it has tended to have relatively low credit quality. The Chinese feel that having Americans come in, American banks will impose discipline. It will improve the productivity and the capital allocation. The second one is obviously that the Chinese, I think, want to have Wall Street in their corner. They want Wall Street to be a friend. They want Wall Street to be, in a sense, beholden to them for part of their global profits, because they know that Wall Street has a huge influence on Capitol Hill.
And it's working, wouldn't you say?
Absolutely, it's working. And I think this is really where the future question comes. If you are an investor right now in Chinese stocks, let's say you hold one of these Chinese internet gaming companies that's picked up, 70% gains this year so far. Should you stop now? Well, I don't think now is the time to do it, because the decision is going to happen in the contest between Wall Street, American industry that is invested in China, and the political sphere. And frankly, the major politicians in both parties would be happy to see this relationship continue. The only one that's pushing back is really the Trump White House. And I think, so it all comes down to the election. And right now, we just don't know how that's going to turn out. Clint, I mean, you've looked at the figures for the financial sector. I mean, doesn't that I mean, it's just a huge piece of pie out there that the Wall Street wants to grab.
Well, yeah, I mean, when we talk about this most recent thread on Chinese stocks and the talk around delisting, yeah, I mean, it's too soon to read too much or to conclude that that's going to go through as is, because yeah, the truth is that U.S. listings of Chinese firms, it's about a collective market cap of $1.3 trillion or so.
Mm-hmm.
And a lot of, there's probably just a handful of names that get a lot of the headlines in terms of the largest Chinese stocks that are out there. But really, these stocks find their ways into a number of investment vehicles. And you may even own some of these stocks and not even realize it.
Right.
I'm willing to bet that if you are investing for your retirement and you hold a target date fund, your target date fund probably holds some of these names that are under review.
Now, but let's take one step back and talk about this whole question of delisting. I mean, that is really one of the threats, and essentially the idea is that because the Chinese firms do not comply with U.S. law regarding their audits, that they shouldn't allowed to list on U.S. exchanges. Now, as an investor, Clint, I've looked very closely. We hold some Chinese stocks in the Bauman portfolio. Have you ever seen any? Yeah, have you ever seen any signs that these firms are fiddling their books?
No, I mean, we take a very thorough review with the names that we recommend. Obviously, there's been some stocks in the headlines recently.
Luckin Coffee.
Like Luckin, yeah, with the fraudulent sales that they were touting.
Mm-hmm.
But with the stocks that we hold, with the stocks that we recommend, I mean, these are industry behemoths that are under in such scrutiny from a variety of investors and other regulators. I mean, this comes down to whether or not Chinese entities are willing to let sort of the U.S. Public Audit Board come in and basically audit the auditors. That's what this comes down to.
Right. Well, let me give you my prediction. And if you're an investor, I think this is the way I would approach it yourself. Right now, I think that the biggest threat is that if President Trump wins re-election and he keeps his current policy orientation, it's quite likely that there will be sanctions that could potentially hurt U.S. holders of Chinese stocks. Marco Rubio, a Florida senator, said he introduced a bill last year that would not affect existing shares, but would prevent new listings. What the current Senate bill does would talk about delisting. My guess is that if Trump wins re-election, there's a pretty good chance that Rubio's version would maybe be adopted, so that there would be no new listings, but existing listings would not be under threat, in which case U.S. investors can continue to hold them. There's also an argument that technically these are not Chinese stocks. They're stocks in Cayman Islands-based vehicles that own the underlying Chinese stocks. I don't think that's going to pass muster. I think the Senate will tweak whatever bill they have to do that. But if Trump doesn't win re-election, or in 4 years' time after that, I predict that any Republican, any Democratic administration is going to go right back to the way things were, because frankly, the U.S.-China relationship is far too profitable to U.S. business for them to allow it to break down. And that is regardless of what the majority of Americans say or think. And that's the way politics has been for a long time. Money talks. And there's a lot of money going on here. So that's my take. I wouldn't do anything with stocks right now, but I would keep watching our videos because we keep a close eye on it, and keep looking at the headlines and see which way the wind's blowing. But my prediction is that right now you're still safe, and it's very profitable to invest in some of these Chinese companies.
I agree. And that being said, we do, again, have a few of them in the Bauman portfolio, which our viewers are more than welcome to check out. There's a link above that they can click and get some more information to do that. Thank you, gentlemen, very much for your insights. And we'll just keep an eye on things like you said. We'll see what this next announcement brings. And everyone just stay tuned. We'll keep you posted.
Great. All right, everyone have a great weekend. We'll talk to you again next week.
Thank you.